The amount of interest you pay over the lifetime of the mortgage is eye-watering. For a typical mortgage, for every pound they borrow, they pay £3 in interest. So imagine if you just borrow £200,000, you'll be paying £800,000 over the lifetime of the mortgage. I was in the studio for 7 hours, and then I was in front of the dragons for like an hour and a half. If you really kind of like lose your composure, it can be very embarrassing, because ultimately all your investors, all your employees, they're going to see you 4 years. I didn't earn a salary. So imagine 4 years kind of eating into all your savings. It was stressful. We got to a stage where, the final bits of our cash that we had as a family.
Hi, everyone. Welcome to 23 Mile with me, Kayode Odeleye. Today, we're joined by Jinesh Vohra, founder and CEO of Sprive, a UK fintech which is helping homeowners pay off their mortgage faster. Jinesh grew up in London in a family of entrepreneurs going back 3 generations. He went to Warwick to study economics and then got into Goldman Sachs as an intern. He turned this internship opportunity into a 14-year career in one of the world's leading banks. In 2019, he left Goldman to start Sprive with his co-founder, Sahad, who he had also met at Goldman. The idea came out of his own experience as a mortgage holder. He paid off his mortgage relatively early at 32 and wanted to make that achievable for the homeowners. Since the app launched in 2021, Sprive has raised many rounds of funding and has grown to over £12 million in annual recurring revenue as at March 2026. Sprive is also profitable since 2025. Jinesh is currently raising more money on a crowdfunding platform, Republic Europe, formerly Cedars, which is an opportunity for the supporters of the platform to also make money from the success of Sprive. On the show today, we're going to talk about how easy or difficult it was to leave the comfort of a well-paying job, how the journey has been over the past 7 years, what it takes to get a consumer fintech to mass adoption, success with fundraising, and what it takes to build for the long haul. Jinesh, welcome to the show.
Hey, thank you for having me.
Yeah, it's great to connect again. We last spoke about, I'll say 4 years ago while I was building my old startup. And I will say you were already showing signs of the success we see today. So maybe we'll just start with what's happening now. Actually just tell us, what is Sprive? You're in the news, you're in Dragon's Den. But for those who are coming across you for the first time, what is Sprive?
Yeah, so it's a free app that helps homeowners pay off their mortgages faster and save interest just by living their everyday life. And there's a few different ways we do that, but the kind of core way is this concept called shop away your mortgage. So imagine you do everyday shopping, but you do that through the Sprive app. And every time you do that, you earn money towards your mortgage, which you can send to your lender with just one tap. And we do other things like you can put spare cash towards your mortgage. The whole goal is helping people save as much interest and pay off their mortgage as quickly as possible.
That is amazing. I mean, from my early banking days, I remember that, mortgages and rent definitely are one of the biggest expenses for most households, right?
Yeah, it's very, difficult to get on the property ladder. I think most people now are kind of, by the time they can save for a deposit, it's very common that they're kind of like in their mid-30s, maybe even in their early 40s. And a lot of people are now borrowing up to the age of like 70, even up to the age of 80. And the amount of interest you pay over the lifetime of the mortgage is eye-watering. Very common for our customers. For a typical mortgage, for every pound they borrow, they pay £3 in interest. So imagine if you just borrow £200,000, you'll be paying £800,000 over the lifetime of the mortgage. And that's after you've obviously earn your income, pay taxes. And then also, you've got to kind of spend to live. So it's a very challenging environment for most homeowners in the UK, and we're here to help.
Very interesting. And you've achieved great success helping people, best of both worlds. Before we get into, deeper into Sprive and how it came about, let's start at the beginning. Tell me what it was like growing up in London.
Yeah, so I mean, I'm born and raised, like you said, in London. Like when my father came to the UK, for example, he didn't have a lot of money. I remember him telling me stories when I was very young that he had 3 jobs. You know, he was like, working at Asda at the checkout. He was, cleaning toilets and things like that, at a local school. And then he decided to start his own business. And so I've seen firsthand how, you know, from kind of very humble backgrounds, my dad's worked very, very hard, to kind of build, and kind of provide for his family, kind of build a better future. And obviously my dad was able to fortunately do well. That kind of helped me have the right foundations to be able to kind of then, you know, do well at school and then build my career from there.
Very interesting. There are 2 things I picked from the account of your background, which incidentally I can see in mine as well. It's one, your dad who built his own business, but also the work ethic. How early can you remember seeing these things or actually being told about working hard, and then building a business?
Yeah, I think it's, working hard is something that's kind of really important, if you want to build a business, because building a business, as you're aware, it's not that easy. And my dad, I think the best way you can kind of show someone is by leading by example. So when I was young, I remember my dad working till midnight every day, kind of 7 days a week. And so, you know, watching him, that meant that when he then asked you to work hard at school and make sure you do your homework, and he had this real culture that he would reward us, like maybe buy us presents whenever we could, etc., only when we did something like good at school and we worked hard. And it wasn't just because it was our birthday or it was Christmas. Like we didn't get birthdays. It was because we worked hard, and he wanted to kind of give us that kind of mindset that if you work hard, you get rewarded. And he was a very hard man to please. So, for example, if I come back from school and, you know, I've done an exam and I come like 3rd in the class, he's like, why didn't you come first? And, you know, it was constantly trying to push and push and push. And I'm very competitive. I like being the best that I can be. So it kind of worked for me. And, it's probably one of the reasons why I had a good career at Goldman's, and then I've done okay with Sprive.
I was smiling because growing up in Nigeria, you work very hard, you come second in class, and then the parents say, the person who came first, you tell them, does the person have 2 heads? Why couldn't you be the one to come first?
Yeah, exactly.
Same thing, right? And then your journey took you to Warwick, where you studied economics. What was it like? Why economics, for your undergrad?
Yeah, so when I was at school, I studied the economics at A-level, and it was my favorite subject. It was something I felt I was very good at. Also, I kind of, when you're young, you're thinking about the future, and I heard a lot about banking and that there was good money in banking, and I effectively wanted a job that, you know, paid well. And so, economics was like probably the best degree to do, for someone who wanted to get into banking. And Warwick University was one of the top universities in the country at economics. Even now it has a very good economics kind of faculty. And so I also like the idea of kind of getting away from London. I felt like I needed to kind of be around different people from different walks of life, because the people that I went to school with, they offer kind of very similar mold. And I like the idea of kind of being more independent, away from the parents, just because I think it's an important part of becoming an adult. Met a lot of good friends. I also met my wife there, so it was a very good time for me.
Very interesting. I mean, it really impacted your life in more ways than one. But while you were there as well, you also got an internship opportunity. If I step back a little bit, you saw the dollar or the pound signs early enough, wanted to be a banker, went to study economics. But from that aspiration to getting a chance to get into Goldman, it's still not guaranteed. But how did you get that door open to you?
Yeah, it was funny because obviously the economics kind of graduation, kind of like the class that I was in, everyone really wanted to kind of work at Goldman's, and so like everyone applied. And at the end of it, I was the only person in my year that effectively got the kind of the graduate position. So I think a lot of people were surprised because I wasn't the most academic, but I was, even at that kind of young part of my life, I was very resourceful, and I was also very specific about what role I wanted. And one of the things I was always good at is storytelling. during the interview process, when they would ask you a question, give us a time that you've demonstrated teamwork or, problem solving. I always had 3 or 4 good ideas and stories to tell to really kind of bring in the interviewer and get them really excited about the value that I can bring. And I think that helps. Like, I think if you can interview well and you can kind of sell yourself, then you're more likely to kind of get through the process. And again, it was a very cumbersome process, lots of like psychometric tests. They had the interviews. I think it was like quite a lot of interviews. And then the internship, once you have the internship, you have like 12 weeks to really prove yourself. And in my mind is that if you don't get the kind of the full-time position after the internship, that's the only person you can blame is yourself. So you just give it everything you've got. And yeah, fortunate enough, it was great because they gave me a position. And it was basically all I had to do was pass my degree in my 3rd year, and I was going to get a graduate position, which was a nice feeling going into my final year at university.
This is probably something that could be very useful for, I'll say, the younger listeners, but possibly even older ones. It's like putting in the hard work, doing your research, be specific on what you want, and then you crack the door open. You have to work hard to prove yourself. Thanks for sharing that. So you did internship, got the internship opportunity. I think the 2nd year, graduated, got the offer. What was it like once you had the full offer and you were inside Goldman?
Yeah, it was great. I mean, I think Goldman Sachs, I've only worked out, in terms of corporate career, I've only worked at one place, and I think it's an amazing organization. I think the other thing that was very good is that Goldman Sachs as an organization was very entrepreneurial. So because I wasn't in the revenue generating division, I was in a more kind of what's called more of an operational area. You're very much judged on soft skills. It's not like you have a tangible P&L, and so that was like really interesting because I started to build a lot of my soft skills very, very fast and very, very early. And one of the ways you did that is by kind of thinking outside the box, problem solving, coming out with, almost creating work. So you've got your day job, which everyone does. And if you don't do that well, then very quickly you'll be kind of showing the door because they have a culture where the bottom 10 to 20% every year get kind of asked to kind of leave the organization. But the way you kind of differentiate yourself is by coming up with ideas and then driving them forward and delivering them. And a big part of it, because when you work in a corporate organization, it's consensus driven. So you need to be able to build that ability to kind of bring other people with you. It's not just you have an idea and then you can go execute it. You need to bring others with you. And I learned that very early on. I also got to manage people quite early on in my journey. So I was probably about 24 when I started managing kind of teams. So I started to get a lot more being able to not only just do the work that I needed to do, but also be able to get the most out of the people within the team. And I think that was a very good skill to effectively learn. And so, yeah, it was just a great kind of foundation for me to effectively kind of build the skill set that I needed to ultimately, one day leave and start Sprive.
But that's interesting, right? I'm an ex-banker myself. You get into Goldman, the idea or the path is get to become a partner you set for life. At what point did you think, I have to step out here, especially considering that it seemed you were enjoying yourself, you were learning, you were growing. What made you think you wanted to leave?
Yeah, so it's a good question. Like my general view was I was never planning to leave. It was just career after career, like promotion after promotion was kind of what I was chasing. And I was there for 14 years. I always liked the idea of being an entrepreneur. So I didn't mention this, but when I was at university, I was thinking, I really would like to start my own business, but I just didn't know how to go about it. And everyone around me was going into banking. So I kind of did that. And I kind of told myself that I'll do this for 2-3 years. I'll build some kind of work experience, skills, and then start my own business. But then once you get into a place like Goldman's, it's very, very career driven. It's very, very much you're competing. And I'm very competitive. It's just my nature. I like being the best. And so you're going for the first promotion is associate, and then, VP, and then executive director, and then obviously MD, and then obviously partner. And so that was kind of where I was at. And then, what happened was a colleague of mine, Saad, who you mentioned in the introduction, he was leaving Goldman's. We used to work together, not indirectly kind of same team, but we worked on a few projects together. We used to go out for a few beers after work. And he said he was leaving Goldman's and he was going to start his own business. And to give you some context, his great grandfather in the 1940s was the king of Hyderabad and was literally the richest man in the world. And his whole family are entrepreneurs. So I think for him, it was always on the cards to do something entrepreneurial. And for some reason, he thought it would be a good idea to see if we wanted to kind of do something together. And, that kind of sparked my imagination because I always liked the idea. It's just obviously you get kind of sucked in. And so we kind of started brainstorming business ideas, and it took us about 5 months to come up with the idea for Sprive, but that kind of sparked the kind of journey. And it was something that I never kind of expected that would happen, but obviously the seed was there, the dream of being able to maybe start something entrepreneurial, but it took someone like Saad to literally kind of pull me out and go through this process. And obviously once we kind of went through the kind of the validation process and I became very excited about the opportunity, I obviously took the risk and quit my job and the rest is history.
Very interesting. I mean, the ingredients are there. From college, you always wanted to build your own business. I mean, you had the good relationship with Saad. How did you end up on the idea that became Sprive? What was that process like?
Yeah, so we used to sit in the Goldman Sachs cafeteria after work, get our laptops out and literally kind of brainstorm ideas. And look, I think we had 6 ideas, and Sprive was the 6th idea. And I don't know if you've ever gone through that process, but initially when you have an idea, sometimes you get really excited by the idea. Yeah. And it's very quickly to then start to go into build mode and get and kind of move too quickly. But we were very careful. And the first idea we had was in the risk space, and then we did a stock lending idea, and then we had an idea on recruitment and lots of different ideas. But as you start to validate the idea, I kind of started to realize the idea had big vulnerabilities that just didn't make sense. It wasn't worth the risk. Ultimately, I have a family. And so I need to make sure that the idea was kind of something I really passionately believed in. And I think the best ideas that you can have are built on your own personal kind of experiences. And so I went through a journey, where, 14 years ago, my wife and I bought our first home. And like most people, you see the mortgage offer document, and this was an interest rate, so practically zero. And it said for every pound we borrow, we'd pay 50p in interest. Really didn't like the idea of paying £150,000 in interest over the lifetime of the mortgage. And so we went through a journey of trying to pay off our mortgage as quickly as possible, trying to save as much interest. And it became super clear that, lenders don't necessarily build technology, to help homeowners kind of pay off their mortgages faster and save interest. And I just felt like the mortgage market was very traditional in the way it operates, very transactional. Whether you're a broker, whether you're a lender, you typically interact with those kind of institutions every kind of 2, 3, 5 years. And I felt like you said, the mortgages for the average person is their largest household commitment. That example that I gave you where you're going to, end up paying £800,000 on a £200,000 mortgage over the lifetime of the mortgage. You need some support. There must be a better way to kind of holistically manage it. I felt we could build it. And then that gave me the confidence to then effectively kind of, go to my line manager and say, look, I'm gonna leave. I'm gonna start this, which they all thought I was crazy. Because most people, when you leave, someone like Goldman's, it's typically because you're going to another competitor, like another bank. But, when they heard I was doing this, they all thought I was mad. But, it's, touch wood. Hopefully it was a very good decision.
I mean, great decision looking back 7 years, but I can imagine it couldn't have been an easy conversation with your family as well. Or maybe put it this way, had you achieved some traction before you resigned, or was this still idea stage?
No, it was literally validation kind of stage. Goldman's have this thing when they're in their contract where if you really build something while you're still an employee, then ultimately, Goldman Sachs own the IP. You're not really, it's not that kind of organization where you can, really start to build a business and also kind of work there. So I had to keep it very clean. So we didn't register the company until I kind of resigned, and we just wanted to make sure that it was just completely separated. So I felt like building a business is very hard. So the 9 months that I spent validating, that was me getting comfortable. And then I firmly believe that if you try to do it something stressful and demanding as a job at Goldman's and a business, you're going to fail. So yeah, I just took the leap of faith. Ultimately, when you think about like investing, there's no better decision in my mind than investing in yourself. If you really truly believe that you can do it, then talk is cheap. The only way to do it is go kind of 100% in. And look, we had £240,000 of capital waiting for us, all based on a PowerPoint. And so if we had the money there, it made sense to kind of resign. You talk about family. That was like, my parents still think I'm mad for leaving such a kind of safe, kind of comfortable job. My in-laws are very much the same. My wife was very supportive. So that was obviously, I couldn't do it without her. I did tell her, before I kind of resigned, that she'd never have to work again, because we paid off the mortgage, and that was part of the reason why it gave us kind of financial freedom. And then I had to sheepishly tell her, actually, I need you to go back to work, because I've decided to effectively, do this venture. So she's still unfortunately working today because of my ambition, but hopefully in the long run, it's going to be worthwhile for both of us.
I mean, you mentioned earlier on that you were very good at the soft skills, having hard conversations. So I can see you putting it to good use there. But then you mentioned something, very remarkable as well. That as at the time you resigned, you already had £240,000 commitment from external investors. I mean, just to clarify, from external investors, not yours hard savings.
No, so I did put in, each of the founders put in some of their own cash. So there was a little bit of that, but the 240,000 was in additional to the money that we were putting in ourselves. So we put in like £60,000 of our own kind of capital, and then 240,000 was from, external investors. Yeah. So the way we kind of typically do it is friends and family. So people we went to either university with, or we worked with, or just people we knew in our network. And we have multiple founders, so we all kind of were able to kind of bring in money from our kind of our network. And I think people generally know us. So once you start to tell them that you're really thinking seriously about leaving a job like Goldman's, that obviously kind of resonates with people. I think talking about the idea, I never asked people for money. I would just tell them about the journey that I was on, and then people would effectively get FOMO and say, can I invest? So I feel like friends and family, it's always a bit dangerous, like asking people for money. But the tip is that if the idea is really, really strong, then you just tell them about all the exciting things that are happening in the journey you're on, and you'll find that people start to get FOMO and they start asking to be involved. And we had like some high profile investors, like in terms of like people like the former CFO of Microsoft, US and India. He wanted to invest, and people say, well, if he's going to invest, then I want to invest, and things like that. And before you know it, we had some capital to be able to build this, because you can talk about bootstrapping, but bootstrapping a fintech is not easy, because we're talking about like there's a lot to it. Like we're ultimately connecting to lenders, and there's lots of anti-money laundering, and there's lots of other things that go into our app. It wasn't, especially this was pre kind of AI. There's no way you can really do this without capital.
I like that tip in terms of raising friends and family to validate the idea, but not directly asking them for money, just showing them the journey and letting them believe in you. Thanks for that. I'm sure many will find that useful. But then here you've got your savings, you've got £240,000 extra in the bank. That is just the beginning. Walk me through the journey of turning that cash in the bank into a working app. What was that like?
Yeah, so we kind of resigned, and then COVID happened. So so it was obviously like an interesting time. And that kind of impacted the way we kind of went about building this. And we, won't go into too much detail, but that presented definitely challenges. The first version of the app wasn't very good. So like my co-founder and I were having debates around what the product should be. And I had a vision around what I think would be the right product, but it was quite expensive. And my co-founder read a lot of like founder books, and it's like MVP. And so he was off the mindset like we should build something much more basic first, And then once we built that, then if it makes sense, we can build something more. Like, it was just a different kind of mindset. And I wasn't sure. What was good about it is that we were able to test certain functionality that became very, very important in terms of like risk. So I'll give you an example. Like, the app helps people pay off their mortgages faster, and we have connectivity to lenders. And ultimately, you want all of that to be seamless. Last thing you want is to press a button in the app, say pay to lender, and then the money disappears, and the mortgage holder doesn't know where the money is or what this belongs to, etc. So it's part of the MVP. We got that part like really, really strongly validated, but we couldn't get customers. As in, customers might try it, but they wouldn't stay and use the platform because it was just not automated enough. It was very, very manual in terms of the way it worked. And so we then used that kind of learning to then build a version that we ultimately launched in the market with. And that product did a lot better. It had obviously still, it wasn't perfect. There were problems around, like, it ended up being a product that customers loved, but it didn't make money. And so that was another journey in itself to, like, how do you build a business that actually makes money? So people say MVP, but sometimes that isn't the best like strategy, because you can spend a lot of time and money building something and then you're building another product again. And if you're not very capital efficient, then you might run out of money and then actually have nothing at the end of it. You want to make sure that if you're making mistakes, you make mistakes fast and you learn from them, and they don't kill the business because you've spent too much time or money. If that makes sense.
There's a lot you said in that last segment, but I think I'll just dig a bit into them. You talked about the customers not really using it because it wasn't good enough. But how did you get the first set of customers in the first place? How easy or difficult was it to do that?
Yeah, so in the first version of the app, that was literally a lot of that was kind of friends and family initially, and just people within our network. And then we then started to, as we started to kind of mature and get an idea of what the product that we were going to publicly launch with, then we started to do like a waitlist. So, and again, we didn't pay people to join the waitlist. We would use social media. The main thing that we did is I would post on LinkedIn, pretty much religiously every day. And I would talk about the journey that I was on. And I had probably about, at the time, about 500 LinkedIn followers. So not many. Most of them were all kind of from the world of banking. But if you think about people in banking, a lot of people in banking like the idea of being an entrepreneur. But because of the safe kind of, the safe kind of element of being in an institution like that where you get paid well, most people obviously don't take the risk. And so when they see you talking about every day the journey you're on, whether you're doing a podcast or you're talking to, going to this meeting, whatever you're doing, people kind of really kind of connect to it. And a lot of people on LinkedIn also, they have mortgages. Yeah. And so, before you knew it, we had like 2,000 people on our wait list. And so that was really good because we were able to then drip feed onboard them before we went publicly live, to kind of make sure that the product made sense, it was clear, and that we felt it was strong enough to be able to launch. And then we decided on a launch date, and we didn't want to launch during COVID because I just felt like that was a very uncertain time. And people don't make financial decisions when there's a lot of uncertainty. But once COVID ended, we launched. So we launched on the 1st of October, 2021. And we hired a PR person to help us effectively do the launch. And on the first day of launch, we had an article from This Is Money, and it was like the UK's first mortgage overpayment app. Is it any good? That was the headline. And on the first day, we had like 4,000 people download the app. And so that was like a really good kind of start. And then on the back of that, we then were like, okay, we need to raise more money because obviously our growth went like that. And so we were still pre-revenue, but when you're raising money, you always want to do it on the back of momentum. And because if you wait too long, then too many other data points can kind of be asked and come into play. And so we raised money, and that was then allowed us to kind of take additional capital to then also kind of build and continue to kind of grow the product.
Like you said, basically just building out from your own LinkedIn, from your own social media to 2,000 users, which is remarkable. How was the first fundraising attempt? How was it different from the initial relationship-based friends and family round?
Yeah, so obviously the first one was the friends and family, which I've kind of touched upon. Then the next one was very much more angel investors. So again, I did try. institutional investors, and we did get one institutional investor that joined our cap table. But most of the investors was kind of angel investors, and it was a good time for fundraising. I'll be honest, because you're talking about 2022 was where there was a lot of money lying around. Interest rates were still relatively low, and so a lot of people wanted to kind of put money in businesses like ours to try to chase kind of higher returns. And so we would pitch. I would talk about the vision. Talk about the fact that the mortgage market is a £1 trillion market, very traditional in the way it operates. The fact that, it's, very transactional, and just talk about the kind of my vision, and then talk about how we are solving that, and then show them the early traction around, look, in the first day, we've had 4,000 people kind of download the app, and, show them that, paint them a picture on how, we think that we can really do, some damage and really, really innovate. And I felt with individuals, it's a lot easier because you have a conversation. If they like you and they like, what they're hearing, they'll put money in. And the UK is great in terms of, the kind of the EIS and the SCIS initially, and obviously then EIS. You can get, first 150, you can get 50% of your investment back in terms of like tax relief, and then 30% for EIS. And so if you're risking, say, £10,000, actually you're risking 7,000 because 3,000 you're going to get in the form of like a tax benefit. And so, that's what we would do. We would get like, some people would put in 10,000, it was fine. But we ended up having like 80, angel investors. Some conversations would be like, they have a chat and someone will invest 10 grand. Some will be like, I'll invest £250,000. It really kind of varied. And I always build on, my network. So people that I know, and if they want to invest, then I ask the question, who do you know? But there's sometimes I did podcasts, and then people listening on the podcast will reach out to me saying, can I invest? And then they have friends, and then there'll be like angel syndicates, and I did like accelerators, where then at the end of the accelerator, I would publicly pitch on stage, and then people would hear me pitch and they say, can I invest? So just lots of different like people in the industry. So it was very like kind of varied. And it was great because we ended up, also getting an institutional investor at the end who decided to invest, and they've invested in every single round since, which was good. And that gave us a little bit of credibility as well. So yeah, it's, there's no like easy, because people say, oh, I came from Goldman Sachs, so I must have like a library of investors, but it doesn't really work like that because I worked in risk. So in risk, people, as the name suggests, they're very risk averse, and they're not like, these traders and these, guys in M&A and corporate finance who've got, £1 million bonuses that you read about, when you're reading the papers or watching like Wolf on Wall Street. It's very different. These are kind of, they're well off, but they're not that well off, that they're not kind of in that mindset of like investing in businesses like mine. So, I didn't have a black book, where I could kind of reach out to. I had to create the network from scratch, and things like posting on LinkedIn, every single day, things like that really does help. And I was fortunate enough to be good at kind of pitching. So when I was talking to individuals, I had like an 80% success rate that if I met someone, there was an 80% chance that they would invest something.
Very interesting. And then, you mentioned the first, I'll say the seed raise, what you were still pre-revenue. How did you end up figuring out a revenue model that made sense for the app?
Yeah. So initially there was a time where like investors would just give money on like growth. And then ultimately they kind of work out that if you capture the consumer, then eventually at some point you'll kind of monetize them. That was kind of the mantra at the time. So it was like grow at any cost and then work out, later on how to make money. And the macro environment changed, obviously, with like things like the things that happen in the macroeconomic environment where rates started to rise significantly. And a lot of consumer fintechs especially were starting to fail. Because the capital started to kind of run dry, and because they weren't making money, the businesses kind of fell over. And so, a lot of investors were very much focused on unit economics. And so I knew that, while we got money in the bank, if we didn't get our kind of our revenue kind of model sorted, that we would also go the way of the dodo. Very much, we kind of saw with the macro environment that a lot of homeowners were saying, I don't have spare cash to put towards the mortgage. Because when we first started, we were an auto saving app. So the whole concept that I mentioned around shopping, that didn't exist. So you link your current account and then we squirrel away spare cash with one tap. You can make payments to your lender. Now, if you're more affluent, it's fine. It's great because you're chipping away. You can see how much interest you're on track to save. But every payment, every customer was costing us money. And we started getting customers saying to me, I really want to pay off my mortgage faster, but I don't have money. I don't have extra money. Like being able to like afford my monthly payments, my monthly mortgage payment is hard enough. Forget about overpaying. And so we start to see very early on, like people starting to close their accounts. This is when interest rates started to like kind of increase. And very early, I picked up on that trend. And so I like the idea of imagine if you could do everyday shopping and get free money for spending on your everyday life. Cause ultimately everyone's got to live to eat, right? They've got to eat. They've got to buy groceries. They've got to, their people, spend money to kind of get by. And so I started looking at that. And it took me about a year to 18 months to get that kind of going. But because we were very capital efficient, we had the time to be able to effectively make that happen. And now, fast forward, we have someone shopping an app like every second to 2 seconds. So every second or 2 seconds, we're making money. So on an annualized basis, we do about 280 million pounds worth of shopping sales through our app. And so people, doing their groceries or their holiday or their takeaway or their cup of coffee or anything they do in their life, we want them to do it through the Sprive app, and the revenue is funded by the merchants. So merchants pay us for every kind of shopping transaction that we drive to their stores.
Over the years, you've raised multiple rounds of funding. You've stayed alive. You mentioned the funding drought. You've stayed alive. You've continued to grow. And then you ended up on Dragon's Den. That is very interesting. Tell me about that.
So, I've, like most people in the UK, I've been watching Dragon's Den since I was like 20. Yeah. Even when I was at Goldman Sachs and I was in the pub, you talk about starting your own business and brainstorming ideas. And a lot of the inspiration came from programs like Dragon's Den. And if you think about it, like 3 million people watch that show. So it's a very good way of getting people to know that your business and your product exists. And so I was fortunate enough to be selected. And I'd known some founders who'd been on Dragon's Den, and they obviously told me how transformational it was for their own particular business. And so when they reached out to me, obviously I did the application. I was fortunate enough to kind of get through and be selected. And once I was selected, it was a no-brainer for me. It was very much just, I went in the mindset of trying to get all 5 dragons to effectively, want to accept on TV. And I wasn't successful. At the end, it was only 3 dragons that, decided that they wanted to invest in Sprive. But for me, it was very much like, if you think about what we do, we're mortgages, we're financial services, trust is everything. And dragons, they're household names, people like, Peter Jones and Deborah Meaden and Tuka Solomon. They've been on that show for a long time. So, they've done their own kind of due diligence. And at the end of the day, if they're willing to put their name towards my business, I felt like for an average homeowner, that is like huge. And that would kind of build enough trust to be able to kind of get people to try the app. And it was great. Like on the back of the airing, it aired on February 2026. On the back of us kind of featuring, we were the most downloaded finance app in the UK. So that week we had more downloads than Revolut, more downloads than Monzo, Trading 212. So I've got a picture of my office now where I've got Sprive is number 1, and then the other apps below me, which is a nice kind of accolade. It's kind of a nice achievement because it's not. I know many fintech founders, and there's not many that have kind of been able to do that. And then. It's just, been good. Like since I recorded the actual Dragon's Den episode in probably March, April, 2025. So it was nearly a year from when I recorded it to when it aired. And during that time, we'd grown 20 times. So we've just gone through a real nice period of growth. So it's just been a very good time. Doesn't mean that, we need to rest on our laurels. There's a lot to continue to kind of do. And I still think the app has huge amounts of areas where we can improve it. And so the team is working very hard to kind of make that happen. But yeah, it was a great experience for sure.
I mean, come on, Jinesh, you've got three of the biggest entrepreneurs in the UK, three household names in the UK to say yes to your deal, and you're saying you were not successful. I mean, that is something only very few founders can only dream about, and you achieved it. So, I mean, congrats on that. Congrats on the growth it's brought. But maybe one more question for me on the Dragon's Den experience. What was your strategy going into that filming, that experience facing the dragons?
Yeah, it's one of those things. It's a high risk strategy because obviously it's great because obviously you get a lot of visibility if you get aired. So there's no guarantee that you will get aired. So obviously there's the producers that need to decide whether it's something they want to air, and I don't know what the percentage is, but obviously I really wanted to make sure that I put my best foot forward. Also, it can go two ways. I've seen episodes where the founders completely collapse under the pressure. There's no retakes, so it's you say what you say. The cameras are continually rolling. I was in the studio for 7 hours, and then I was in front of the dragons for like an hour and a half. So it's very, very grueling. There's like lots of cameras in your face. There's lights. And so if you really kind of like lose your composure, it can be very embarrassing because ultimately all your investors, all your employees, they're all going to, if it gets aired, they're going to see you. And if obviously you completely lose your composure, then that's not good for the business or the brand. But I was very confident. I just firmly, you can't shut me up. I love talking about Sprive. So, and I've obviously, been, through a few rounds. So I know the kind of questions that investors ask. So it very much, as you go in, it feels like a normal pitch, because the questions they ask are good questions. They're questions that any investor would ask. The only difference is the cameras and the lights. So I think the hardest thing is to get your pitch. So if you watch the episodes, you get initially like a 2-3 minutes, to basically pitch your business. And that's the bit that you need to like make sure you get like spot on, because the rest of it, you can't really rehearse. You're just answering questions, and you're trying to answer them in a way that's not too complicated so that the average homeowner and the dragons can effectively understand. And so at home, I would practice my pitch. I didn't get a lot of time. I literally had 2-3 days to be able to effectively learn my pitch. But it was very important to them that I said it like word for word, especially because I'm in financial services. They wanted to make sure that everything I said was completely 100% true and fact checked. Because ultimately the last thing the BBC want is, someone like me making claims on national TV and then they ultimately completely lies, because the BBC are very big on, especially in this day and age, around credibility and not kind of publicizing kind of fake information. I think in the past they've been burnt with dragons, investing in businesses. Ultimately the actual facts that the founders made are actually true. And so I got my kids to like help me. So I'd literally like at home be doing my pitch, and I'd be like distract me, push me around, jump on me, scream in my ear. But the whole idea in my head was that if I can deliver the pitch under that craziness at home, then I'd be completely comfortable being able to do it, in the den. And by the end of it, my kids were like really annoyed. They're like, "Dad, not again," because obviously repetition is like really like key in terms of like muscle memory. But I knew that once I nailed the pitch and I did that, and I felt like I knew I'd be able to do that, that gave me confidence going into the studio and into the den, that, I will nail that. There's going to be very unlikely that I'm going to be able to be phased. And then once I nailed that pitch, that kind of lifts you. And then the Q&A, piece started. And even that bit, like I had to adjust. So I do a lot of like investor pitching. So in a normal investor meeting, if there's a question that they ask you and you don't understand, you literally would be like, "I don't understand what you mean. Can you clarify the question?" Whereas on live TV, effectively, you can't do that. So I remember Deborah Meaden asking me a question, and she used the word layering, which I never heard of in the context of what she was talking about. And so I answered the question. Then she was like, "No, that's not what I mean." And then she she explained herself, but under the edit, it can come across like I don't know what I'm talking about. And then there was like another question where like Stephen Bartlett asked me about cost to acquire customers. And there's a lot of like context behind my answer that would normally provide an investor, because we'd not done really paid ads until like 2 weeks before I actually entered the den. And so I wanted to give that context. And he went back and said, look, you're not answering the question. So I really quickly realized that your responses need to be super concise. And that like, I usually do a lot of storytelling with my responses, but that wasn't the right kind of forum to do that. And so I had to really on the fly adjust to the environment that I was in. So that was probably the hardest thing. But otherwise, you know, it was an experience that I really enjoyed and no regrets. And yeah, it's obviously been good for the business and my family as well, watching the episode with my wife and my 2 young boys. It was a special moment.
So, I mean, 7 years in, was this finally the moment your parents said, okay, fine, we agree leaving Goldman was a good choice?
No, they still don't think it's a good choice. Yeah, they still think it's, I think they don't really know what Dragon's Den is. And even then now, my dad would be like, you're crazy, leaving a job like Goldman. So I think the only time, he will like really, really like say you're doing the right decision is when, you know, I can like, there's like potentially a life-changing moment where, you know, it's like irrefutable, but at the moment he still thinks I'm mad.
Okay. So that keeps the fire going, right? Like you can't rest on your hands until you IPO, and then your parents are going to give you, then they will agree it was a good idea.
Then I'll get my pat on the back. Yeah.
Yes, you will get your pound. So yeah, I mean, natural motivation to keep working. You know, thanks for that. And, you know, I mean, despite all the growth, despite the capital efficiency, you mentioned you've achieved most of this growth organic, you know, through organic growth, which is impressive. There's still a long way to go. Tell me, how do you see Sprive evolving over the years to be able to achieve, I mean, if nothing else, to achieve the recognition from the parents and then, of course, help more people?
Yeah, look, there's 11 million homeowners in the UK. So like, you know, we have over 160,000 homeowners currently using the app, but, you know, there's a huge amount of market to grab. In my mind, you know, who doesn't want to pay off their mortgages faster? Who doesn't want to save interest? And so we want to find more and more ways for helping homeowners effectively pay off their mortgages faster and save interest. So at the moment, we're working on a pilot, called the Anywhere card, which is effectively anywhere you can shop with MasterCard, you can earn money towards your mortgage. So imagine, you know, whether it's your haircut, your local pub, your local high street, anything you can think of, any of your online shopping, effectively anything you do in your life, you can earn money towards your mortgage. We think that would be really powerful and exciting, to kind of help people accelerate their journey towards mortgage freedom. We're also creating like a savings product, where the interest you basically earn on your savings goes towards your mortgage. So say, for example, Coda, you've got like £10,000 in your savings account with Sprive. Every month you'll put £25 towards your mortgage. So on an annualized basis, that would be like £300. Now, I mentioned before, like for every pound you borrow, you can be paying £3 in interest. So on £10,000, £300 capital plus £900 interest, £1,200 on £10,000 isn't too bad, in terms of a return. And it's a very nice passive way of being able to like chip away at your mortgage. So when we want to build things like that, which we're currently working on, we want to do other exciting things like maybe, you know, your parents can help you pay off your mortgage faster by maybe gifting money, or maybe they can do shopping and every time they shop, they help you pay off their mortgage faster, or maybe they put savings in a Sprive account and the interest they earn goes towards your mortgage. So, you know, creating much more of that kind of family dynamic. We want to help people find the best deals. So whether you're buying for something, make sure you get the best price on the thing you're looking to buy. Because that means then you have more money to be able to then put it towards your mortgage or spend it on what other things you need to do to kind of get by. The best kind of home insurance deals, car insurance, pet insurance, energy, broadband, and ultimately remortgaging. So if you refinance through us, what we want to do, it's not quite there in the app at the moment, but we want to be like the largest mortgage intermediary in the UK. And we want to do like crazy things like, you know, at the moment, a lucky customer every week gets £1,000 towards their mortgage. and the new customer gets a chance to get their next monthly mortgage paid on Sprive, and that happens every week. But we want to be more ambitious. Why can't next year we do a campaign where we pay someone's entire mortgage off? And ultimately, in my mind at the moment, there isn't anyone who's the consumer champion. And so we want to be that player. And it's really nice. Like, we support 14 lenders at the moment. So, Barclays and Santander, NatWest, HSBC, a lot of the big lenders, but we now have more lenders coming to us. So I can see very soon we'll have like 20 lenders on our platform. And it's really nice because, Kylie, we've known each other for a while. In the early days, it was me reaching out to lenders, and, it was a very different dynamic. Obviously, when you're a startup, the power parallel is very different. But obviously now it's a good sign when like homeowners are effectively saying, well, when it comes to remortgaging, if you don't work with Sprive, I'm not gonna get a mortgage product with you. And then people at the lenders are like, well, we need to be part of Sprive. And so we're just trying to change the whole paradigm. I see a world where, why can't we digitize mortgages? At the moment in the UK, it takes a long time to refinance. But across Europe and the US, it probably takes the longest to remortgage because the technology is so archaic. But if you think about like life insurance as an industry or like insurance in general, it was heavily brokered in the past. It's a lot more digital now than it ever was. And I see the mortgages going the same way. And we want to be part of that journey. I feel like, why should homeowners be judged on crude affordability criteria like loan to value, where everyone's bucketed in the same kind of group, depending on like if your loan to value is like somewhere between 80% and 85%, then you get access to a certain level of deals versus someone who's 85 and 80 or whatever the threshold is. But everyone in that individual has their own different financial circumstances. So why can't we price it on a more individualistic basis? And why can't we, if we digitize it, then all those overheads that the lenders have, can some of that be passed on to the customer so they can get better mortgage deals? And my dream would be that ultimately one day that Sprive customers can get mortgage deals that no one else in the market can get. And so this is the vision, but ultimately the goal is to revolutionize mortgages. And then who knows, maybe we can help people pay off student loan debt, credit card debt, car finance. Like at the moment, I'm talking to government around student loans and really trying to encourage them to see if there's a way where people can sign up to Sprive when they're at university, as an example. And then every time they shop, they're paying off a bit of their student loan. If they start at the very, very beginning, then you'll be, able to kind of be more in control over that debt, because I'm not sure how much you've seen the press, but there's a lot of press around, the fact that a lot of people will have student loans into retirement, which is not good, because ultimately people are paying 9% on their student loan. So it's much more expensive compared to a mortgage. And how are people supposed to get on the property ladder if they can't get on top of their first debt that they're taking out on the back of university?
Very interesting. You've got a long way to go. I mean, and I hear all of this and I'm like, yes, they should exist. And is that why you are at the moment also fundraising on Republic? Is it to finance this? Tell us about that, the campaign and how that is going.
Yeah, so it's finished now, but it's effectively, we were looking to raise 5 million, and we raised it pretty quickly. And then I had people that I knew that wanted to invest, but there was like a minimum amount that a certain individual at my stage could effectively need to have to be able to invest into Sprive. And I just felt like it was very unfair. I think, people who are passionate but don't have huge amounts of money, I felt like they should also get the chance if they believe in what we're building, then why not? And so I kind of, Republic reached out to me, and they've been reaching out to me for a while saying, you should do it. And I just felt like, we don't need to do it, but if there's people that want to do it, then let's leave it open. And so we did it. It wasn't like a really important part, like from a business perspective. We had the money we needed, but we felt like if people want to invest, why not allow them to? So we did very little marketing on it. We sent one email out to our user base. I did one LinkedIn post, and then we just kind of said whatever we get, we get. It wasn't something that we really needed to do. It was just something I felt like, especially our customers. if our customers can, gain on the upside of what we're building, then and obviously there's a risk involved, because with any kind of investment, it can go down to zero. But we wanted to give people the opportunity.
Congrats on that. I mean, it's been what we've been talking about over the past hour, how you've turned the success of the business into attracting the capital, which then builds the business. So, great, great story there. Anyone listening to this it sounds like almost a smooth journey so far. Has it been a very smooth journey over the past 7 years, or have there been near-death moments for Sprive?
Well, 7 years, I would say that's a long time. So I don't think, in hindsight, when I left Goldman's back in 2019, and I thought it'd be like 2-3 years, and would be where we are today. And obviously 7 years is a long time. And I think the hardest thing is finding product market fit. And like, it's very easy to like burn a lot of capital. And then once you burn it, if you've not used it wisely, you're gonna fail. So for me, in hindsight, it was probably like, okay, but it has taken a long time. 4 years. I didn't earn a salary. So, imagine 4 years kind of eating into all your savings. For the average person, that could be very stressful. And obviously it was stressful. We got to a stage where, the final bits of our cash, that we had, as a family, until I could start to pay myself, something that, makes financial sense. So from that perspective, it's challenging. We had COVID. We had things like the kind of the cost of living crisis and rates rising, and having to find out the revenue, work out a revenue model, before we kind of run out of capital. Investors generally don't like consumer, fintech, because there's a graveyard of consumer fintechs over the last 5 years. Most of them not been successful. So as a sector, and mortgages especially, those sectors have not performed. So VCs tend to, back sectors that are where there's a lot of examples of winners. So that made it challenging. So it's been difficult without going into details. I would say building something like Sprive, it's like a roller coaster. Once you're on, you can't really get off, because people are ultimately trusting you with their money. And then you just got to do the best you can. The key is to be really, really resourceful, build a network. And then as problems come, really quickly just be able to leverage your network to be able to effectively find the solution. But, even now, given the stage we're at, there's still challenges and curveballs and nothing's easy. So it's, if anyone wanted to be an entrepreneur, I'd say, I think doing something like what I'm doing, which is very ambitious. You're trying to change the way people manage their mortgages. It's a £1 trillion industry. Change the way people think about debts. I suppose the likelihood of success is probably, you could say it's low, but at the same time, if you don't try, you don't know. If I had that mindset, I would have taken the leap, and I wouldn't be where we are today. But what I would say is, anyone looking to start a business now, there are easier ways to start a business and make money. I think with the world of AI that we're now in, I think vibe coding and things like Claude, and you can build a lot for very little money. And so I would say, try to build a business that you can bootstrap, earn your first, £10,000 revenue, then 50, then 100, and try to build a business like that. And then maybe you can build something that replaces your lifestyle and funds your lifestyle, funds your income. And then if you have ambition about beyond that, you can either use that business to take it to the next level, or start a more ambitious business, but you're not worried about your family and your financial security. You've got that already covered. And at the moment, I feel like with the rise of tech, there are thousands and thousands of ideas on how you can create a business that earns £100,000 a year. I could do that with not being arrogant with the network I've built now. I think there's so many ideas you can come up with. Because the way I think about it is, there's a lot of people out there who earn £100,000 a year, and they do that without zero, tech capability. They just do that because that's the way they've always done it for the last 10, 15, 20, 30 years. When you start to take AI and put those into those businesses, which some people will never be able to do, you can have a massive comparative advantage. And, if you can do that well, quite quickly, you can surpass that person's individual income that they've done in the old fashioned way is my general view. And there's just so many use cases right now. It's the best time to become an entrepreneur. Like, I worry about children in school, and when they come out of it, if they're young, a lot of the low hanging fruit is already going to be disrupted, by people who've taken the risk. So, I think it's safer now to be an entrepreneur than it is to be a career person, because I worry in 10, 15, 20 years, I think a lot of people are going to, it depends on the sector, but a lot of people might find themselves being shown the door, and then what happens next? Whereas with entrepreneurship, there's a lot of the easy, low-hanging fruit. So if for the brave, I definitely think it's worth it.
Amazing. I mean, I would just like to dig into one of your responses there around the personal sacrifice. You were funded from the very beginning. You had the £300,000 in the bank account before you left Goldman. What was behind the decision not to get paid for 4 years? I mean, why did you decide to do that?
Well, because I wanted the business to be a success, and if I paid myself, then I would probably run out of money, and the business would have effectively not exist today. So when you're building something, if you truly believe in it, you need to put the business first, not yourself, is what I believe. And it's 100% true. The numbers don't lie. If I paid myself, like, it's only like early this year that I actually started to pay myself something that didn't eat into my savings every month. Yeah.
Wow. That is impressive. I mean, it just goes to show how, I mean, you touched on it, like when you're building something ambitious, it's always going to be painful. There will always be sacrifices, but we all hope it pays off. Just in wrapping up, I have a few quick fire questions that if you can answer in, maybe 1 or 2 words, that'd be great. How would you describe entrepreneurship in 1 word?
Exciting.
Very interesting. I love that. And what about a myth about entrepreneurship that most people believe, but it's not true?
It's going to make you rich in the short term.
It always takes much longer. You've kind of done both. You've bootstrapped, you've raised VC. Which is better?
So like I mentioned, right now, bootstrap.
Bootstrap definitely do something that works. And then on the last point is you've raised all this money. If I have my facts right, about £7 million, and you've just raised again. What's the path to exit? How are you thinking about exiting the business in the, I'll say, medium to long term?
Yeah, I mean, ultimately, my general view is that as a founder, you don't focus too much on the exit. You focus on building the best business possible. And then if you do that, people will notice and they'll come knocking on your door, and then you can see what, if it makes sense to exit or not. I think at the moment, I feel like the opportunity is huge. Like globally, there's 1 billion people with some sort of debt, and everyone shops, everyone saves. So I think for me, just head down, make every day count, and then, see what the future brings.
Amazing. Thank you so much. But maybe last question, also something you touched on. I've grown up in London, built business around London. What's your short view in terms of building in the UK now versus, say, running to the US or running to Dubai?
Yeah. So most investors think like UK businesses are not great businesses because the UK market is very, very small. We know things like Brexit. We've become a lot more insular. The UK economy is not growing as quickly. It has a lot of political challenges. So a lot of people overseas see UK as not a very, very good market. A lot of international investors, when you talk to them about being a UK fintech, immediately they're kind of put off. If you mention that you're looking to expand to other geographies, that's when their kind of eyes light up and they want to kind of hear more. So a lot of investors will say, Jinesh, forget the UK, build this in this country or that country. But I'm a firm believer that you should start somewhere and you spend a long time. Like, it's not easy. We talked about quite a lot that, it's taken time for me to build the business to where we are today, that you need to really see that through, and maximize the opportunity in that particular market. And then from then, if you want to expand to other geographies, you can. But obviously the US market is huge, very, very exciting, but a lot of businesses have gone there and failed. There's not many kind of UK fintechs that have gone overseas and actually done really, really well. A good example is Purple Bricks they went to the US and ultimately that company went, insolvent. And there's other stories. I don't want to mention too many, but even others that are in the market that are like trying. And the US is like 50 states, right? So there's like 50 countries in one. So it's like trying to take on 50 countries, and it's challenging. And I think, marketing is very, very expensive. So you got to raise a lot of money. In my view, unless you can have a superpower in the marketing space that no one else has, it's very expensive. If you raise a lot of money, you get, as a founder, diluted significantly. So it's like, I've got ambitions, don't get me wrong, but walk before you can run. So, but yeah, there's no doubt about it that there's other markets like the US are, on paper at least, more exciting than the UK. But obviously, I'm born and bred in the UK. Everyone I meet around is in the UK. They're all having a really hard time with mortgages and debt, and I want to help. I mean, the number of customer stories that I hear firsthand around how we're helping them, it's nice, and because I've been here all my life. I'm from the UK. It's nice to be building around people that you know, and communities that and so I've got no regrets. Investors would love me to obviously go to other geographies, but for now, UK is where we're focusing.
That is amazing. And I love that. I personally believe as well that, London has a great prospects for being a tech capital. So we'll see how that goes. Thank you so much for joining me. Thank you for a wonderful conversation. We'll be rooting for Sprive. We'll be rooting to see how all the wonderful ideas you have come to life. And, yes, thank you very much, Jinesh.
No, nice to have this conversation. Thanks for inviting me.